Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, February 25th, 5:10 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at what you need to know for next week, and update the world famous 21 over 21 leaders list. A lot going on in the market this week. Let's get right into it. State of the market. So over the last 2 days, we've gone from a bearish consolidation to a day two rally. We're still consolidating under the 200-day moving average. That's the bad part. The good part is we had what looks like a big washout. We reached 10% below the 50-day moving average. That has been historically a pretty reliable signal that it's time for a bounce, and it didn't fail us this time. And when we started to bounce, we started to take a couple positions, and we've seen follow through strength since then. So a nice 2 days up in the market. Check over here in the trend gauge, still not good enough to get us above any of the key moving averages across the major indexes, but we do have green arrows on the sub trend while the major trend stays neutral for market leaders. Surprisingly, the 21 over 21 list has held up very well over the last 3-4 weeks while the market has sold off. So it was the garbage that kept going down while some strength was maintained across several broad sectors. So good news over there for the market overall. So leaders still at neutral with a trend toward bullish. Short term, this is where are the 5 major moving averages versus their short-term 21-day moving average. Still underneath it, but with a red arrow pointing toward neutral as we climb up into it, and that's going to be a big test for the market next week, and we see if they can get above their 21-day, their declining 21-day moving averages. 50-day moving averages are medium-term indicator, still firmly below there. Long-term, still also below our 200-day moving average. But as you can see with the green arrows, we're now pointing up after this big 2-day move up off of a very oversold conditions in the market. So what just happened today? As I said, strong, broad, all 11 sectors higher on the S&P 500, so that's good. Also, we saw strength across market cap size too, as small caps, mid caps, and large caps all did well. G6, this is our growth proxy, up 2.6%, S&P 500 up 2.2%, NASDAQ 100 up 1.6%. The laggard today after being up over 3% yesterday. Nothing wrong with that action. Dow Jones Industrial Average joined the party today after lagging yesterday, up 2.5%. Midcaps up 2.8%. Russell 2000 up 2.25%. 60/40 World Diversified stock bond portfolio up 1.33%. Our flagship GROTECTION portfolio up for the second straight day in a row, but lagging for the second straight day in a row, up 0.65%. But this is typical depending on where you are in the market cycle. So correction or bear early recovery, moderate underperformance is what we've seen. So we've lagged by about 250 basis points versus the S&P the last 2 days, but major outperformance is what you see when you're in a minor to major outperformance is what you see. This is really where we were in the -10 to -15 moderate correction. So we outperformed the prior 4 days before the last 2-day rally by 500 basis points. So plus 500 minus 250, we're still 250 basis points to the good over the last week and a couple days in the market. And this is it's just typical of what happens depending as we transition from one type of market to another type of market. There's somewhere we're going to be in line, somewhere we're going to slightly underperform or have moderate underperformance, and somewhere we're going to have minor or major outperformance. And here are some time frame examples over there. Complete transparency here at Revere Asset Management. So let's get into the market a little bit, starting with the charts, but let's start with the Fab Five here. The team at Revere, we strive to participate in market uptrends and protect capital in market downtrends. Made some tweaks to our process about a year ago after a harsh growth sell-off in February, March, April of last year, and it served us pretty well. We've actually had 2 growth bear markets since then, November, December, and January, February, and we came away with mid-single-digit losses both times versus 20% drawdowns in growth proxies. So now we turn with the market, start getting re-engaged, look for leading stocks and leading sectors, and look for the indexes to be carried higher by those leading stocks. And if you're interested in this approach, please reach out to any of us. You can email Dan, Tim, Hunter, Muriel, or Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. Let's start off with the S&P 500, and let me also bring up the tail of the tape. Let's start off at the top here. So market state consolidation, day 2 rally. Headwinds in the market continue with the strength in the U.S. dollar. That's a drag on stocks. Inflation, Fed tapering, rising interest rates, and Russia, Ukraine. Let's hope we don't have to add China, Taiwan into this equation. So from a sentiment perspective, put call has been right around the 1.0 very frequently over the last few weeks, and that's kind of where it settled in, and really a couple spikes one way or the other, but nothing major. The VIX has dropped from 39 to 27.6 over the last 2 days. We want to see this get under the 24 area. That's kind of a sweet spot for a market rally. Fear and greed, 31, that's fear, so no complacency anyway. Some of we're going to start tracking these a little closer, but there's 2 other sentiment indexes that showed bears far ahead of bulls. They were taken midweek, so they were taken before this 2-day rally, and that helped to confirm when you get too far lean to the one side, those are contrarian indicators. That gave us a little bit more confidence in putting some positions on as we bounced from oversold. So our bull case now, reclaim the 200-day moving average. We're still working on that, but initiating a rally. So we started that on 224 on Thursday. Prior to that, on 217, the bear case is in effect when we broke back below the 200-day moving average. So let's get to today's action. More news. Russia-Ukraine conflict continues. More sanctions added on, but they've been perceived as weak. And that's one of the reasons why the market has been rallying from several things that I read. Not that you need an explanation, but a thesis with price confirmation is always better than wondering why. So what I was watching coming into today, we had that big rally off the bottom yesterday. Was I going to see continued follow-up strength? And what would happen when we got into 4,300 resistance? We got a broad rally and went through the 4,300 resistance like it wasn't even there. So win for the bulls there. We started today with a small gap up, 0.2%, brief drop, but then a strong trend up, and we traded tight in a range in the afternoon into close at the high of the day. So really a nice follow-up day 2 to day 1. Some notes. Broad rally, as I mentioned, all 11 S&P sectors were higher, and I'm happy to say that these 3 mid and small cap growth ETFs got above their 21-day exponential moving average. This is something to be a little bit excited about. At least it wasn't rejected and reversed. They were barely above it. Here's IWO. This is the Broad Russell 2000. SLYG. This is the S&P 600 growth right above it. I want to see. One of the things we're looking for is make sure we don't fail badly in these areas next week. And then mid-cap growth, a little bit more room above it, but strong bounce along with the indexes off the bottom 2 straight days. So that's a little bit of more weight of the evidence into the bull case when we can see strength in the growth portion, the growth half of the indexes. So bottom line it here, no red flags yet amid a 2-day strong rally off the lows. And when we get that situation, we're going to start adding exposure, and that's what we did. So portfolio, we were flat on Wednesday, went out Wednesday. Thursday, When we saw the bounce, we saw us get 9 to 10% below. We had discussed it beforehand. We saw the harsh reversal started. We bought some broad sector ETFs. We bought QQQ and VTI. Added Expedia, and then today with some follow-through strength, we added more to VTI, bought Datadog, Docs, and AMD, and that took our adjusted beta up to 0.9%. Our cash is still over 50%, but we use an adjusted beta figure in here because owning 10% VTI is not the same as owning 10% in AMD. It's more volatile, it has a higher beta, and a much higher ATR. So we use a formula in-house here to calculate our adjusted beta. So a little bit less than 1.0, which is what the S&P 500 is at. Sectors strong today. All 11 of the S&P sectors: metals, banks, fertilizer, steel, aerospace, defense, delayed yesterday but got into the act today, and a dead cat bounce for home builders. Down today, the US dollar, which helps stocks, and then the commodities themselves. The stocks were up, the commodities were down. Gold, oil, and some people think cannabis is a commodity, but that continues to be very weak. So let's look at the key levels here now. Let's go to the chart first. So this was the first attempted rally on 124, where again we got stretched 10% below the 50-day moving average and had a violent rally, closing at the high of the day. This was somewhat historical. We had never been down 4% before and finished positive. Or it had happened just a few times in history. This was also historical. You don't go from minus 3%, minus 3.5% to plus 3.5%, which was what we saw in the NASDAQ 100. This is the S&P, but we'll look at the NASDAQ chart in a minute. So you see we consolidated after that last move up. We had a Friday where we were looking like we were going to break down, but a strong rally into the close, and then that rally followed through the next 3 days into the week. We got above the 21, but the 21 never turned up. And soon we were breaking below it, going back and forth between the 21 and the 200-day moving average. That's the black line. We tried one last hurrah of a breakout before 3 sharp selling days, a weak bounce, and then 4 brutal down days that started with the Fed minutes coming out last Wednesday. The initial reaction was good. The next 2 days were terrible. And then you can see the action in the last 4 days. 4 days to the downside. The gap down on the Russia invasion of Ukraine just got us, again, 10% below the 50-day moving average, just stretched a little too far. And then you can see the reversal on a 5-minute chart here. Just stretched down too far. Immediately, the rubber band starts to snap back. We go sideways, and right here, Biden had a press conference, and there was some volatility tied to it, but the perception was that the sanctions that were being put on were not really going to be tough enough to impact the overall world economy. A little bit of a pullback, and then off to the races for the rest of the day on Thursday. A little bit of consolidation Friday morning, another leg up, sideways consolidation, kind of tight for all of the afternoon, but a close at the high of the day at 43.85. So nice close. Here we are back on the chart above the ADMA. That's the purple line coming into next week. The declining 21-day moving average, that's going to be the first significant test. So let's go back here to the key levels. We got a lot of levels above here that we're going to be encountering, but the first one is this declining 21-day moving average at 44.23 next week. We broke it on 210. We'll be coming into it next week as long as we don't completely break down. So right now we're back inside this shakeout range after the prior follow-through day, which failed. Today's close at 43.85, and we did this undercut of the 42.23 and closed right on it, and that was good enough. Undercut it significantly and then closed back above it on Thursday. So let's go to the NASDAQ 100 now, the QQQ, very big day on Thursday. As I said, this was the one that was down 3.5%, went to up 3.5%. 1.5% follow through today, coming into the declining 21-day moving average next week. That's your green line. And then overhead, we've got the red 50-day and the black 200-day, which is flattening out but starting to turn up ever so slightly. So there's your NASDAQ 100. Dow Jones Industrial Average was a laggard yesterday, but joined the party today. You can see it barely finished up yesterday after also being stretched and making new lows relative to these recent lows back in May, June, September, November, and the first January shakeout. Close above the ADMA. It also is going to come into the declining 21 next week, and then the 200 and the 50-day. Let's go to midcaps. We talked about how we've been seeing relative strength in mid-caps over the prior 2 weeks while the big indexes were shaken out. And then the mid-cap, the first one of the indexes to get back above the 21-day moving average. So some good news there, one of them above. It's one of the reasons for the green arrows that the green arrow that we showed in the trend gauge. And then let's take a look at IWM, small caps. Also closing above, so some good news there. IWO above, and also the broad index. Value outperformed growth today, so even with growth got above it, we're going to see value above it here too when I look at the value component, IWN. So some good, more good news there for you can see us going up on relative strength over the last 2-3 weeks now on mid caps and small caps. So that's generally a good sign for the overall market. So let's take a look now at the stocks that we bought this week. VTI, broad index. We already looked at QQQ. The first stock that we bought off the 2121 list, actually a new one on the 2121 list. Booking was on there, but had a terrible earnings reaction. We had a nice shakeout with Expedia along with Booking, but it bounced right at the 50-day moving average. And when it started to come up and off in there is where we took the position. So this is the first stock that we bought after the initial strength and after the broad ETFs were purchased. And then today we followed up with Datadog, which has been, saw some relative strength there before the flag. Big gap up. I reviewed like 30 gap up scenarios on stocks with earnings from the first quarter. The initial strong reaction, then the sell-off on lower volume, the final shakeout below the moving averages, and then back above the 50 and the 21 today. So we took a position in that. Also took one in Docs. This is another one that tough downtrend, but a very positive 444% volume, up 24% on its earnings report. Didn't really give back a whole lot. That's what I really liked about this. Note, even though the big move up there, the relative strength line barely wavered, and in fact is right at new high before prices. That's a very bullish sign. I like the way this is acting a lot. DOCS, and then we also bought AMD. Been watching all the semiconductors to see which one would lead off. I liked how it undercut the 200-day moving average and then got back above it and the 21-day moving average and just the 50 days overhead. And when they announced an $8 billion buyback after the close yesterday, it's one of the reasons why this outperformed among the other semiconductors today. So AMD, Docs, Datadog, Expedia, VTI, and QQQ are our current portfolio holdings. So let's go now to the 21 over 21 list. And we're going to start with, we've got 15 industry groups and 15 broad sectors and 21 industry groups. That's where you get your diversification from industry groups and sectors. You don't have to buy foreign stocks when they're in the toilet. That's like buying rotten vegetables just to say that you've got you're obeying the food pyramid. So let's start off with the stocks that got pulled from last week's list. There were 3 of them. The first one, an obvious one, STX, just broke down and didn't really recover. Computer data storage, and honestly, after this big negative reversal and not a lot of volume back up, it was probably the weakest one on the list for a while. Second one, I mentioned Booking with its bad reaction to earnings under the 200-day moving average, so this is definitely off. The last one off just because it's really kind of lagging from a relative strength perspective, and there's better stocks. Not a bad flat base setup, but the numbers aren't great on it for 2022. Growth and the sales weren't spectacular. Nothing really special about a Dollar Tree when we're looking for true market leadership. This is more one that held up than one that is exhibiting any serious leadership. So the 3 that were added, I already mentioned Docs. We bought this. I showed what I liked about it from how it held up tight on its pullback after its earnings gap up. So good move there. That's the first one. The second one was Palo Alto. This is looking like a very clear leader after its earnings report. At the top of the range, cybersecurity stocks had a fantastic week with, it seems like a lot of the warfare now is cyber warfare. So one cyber stock that did not, however, participate is Zscaler. This thing just got really bludgeoned on its earnings report, down 16% today anyway. So Palo Alto was the second one that we added. The third one that we added was Expedia, replacing Booking. So basically just changing out one travel leisure stock to one that's acting a little bit better. Airbnb, a little disappointing this week. One that had a great earnings report, has all the numbers, but somebody must have just had a bunch of it to sell because above average volume selling and then really not that strong a reaction over the last couple of days. So Expedia leading Booking, and also there's another one I can't, TripAdvisor I think had a bad reaction to earnings also. Yeah, that's just a laggard. So, okay, back to the good. Enough about the bad. Expedia. So these are the remaining 18 stocks that are on here. Mattel continues good relative strength, continues to hold up well. Decent numbers here too. I don't know that it has the N, but it's got the sales and it's got the earnings. Capri, nice shakeout off the 50-day reclaim of the 21. Quite a few stocks that are on here did a shakeout and reclaim along with the market this week relative to their 21-day exponential moving average. So Capri continues to be on there. Robert Half, another undercut, not only the 21 but the 50 and reclaimed. Again, most of these you'll see that they've been showing relative strength over the last 5, 6, 7 weeks, which has enabled them to stay on this list while the market has been correcting. Datadog, we own this. Off the 200, back above the 50 and the 21. Great reaction to earnings, good growth numbers, still relatively expensive with a 333 PE. Newmont, ugly shakeout. This was a classic sell the news with gold stocks on Thursday. They have been leading. They gapped up early in the day on the announcement of the invasion of Ukraine by Russia and then sold off hard. Decent bounce for this one, still holding up pretty well, never even touched the 21 on the pullback. Nucor, 2 big days off the 50-day moving average, relative strength at a new high. Cheniere Energy, great reaction to earnings, a little bit of kind of saw a little bit of shakeout in oil stocks also after that invasion announcement, but oil stocks for the most part staying very strong. This one more of a transport pipeline play. Arch Coal, consolidating sideways after its nice move up on earnings. Schlumberger, undercut, reclaimed. I don't like that the 21 is rolling over here, and keeping a close eye on this one. This one's hanging on barely. MPC, another one that undercut and got back above. Several of these oil stocks, they may need to form some bases here as the 21 is flattening out and rolling over, so we are keeping a close eye on them. Archer Daniels Midland, along with the big day in fertilizer stocks, this continues to lead. 2 nice days to all-time highs or recent highs. I'm just on a daily chart. Lockheed Martin, the aerospace defense stocks had good days on Thursday and Friday with volume. GLW Corning bounce off the 50 and the 200 back above the 21. AbbVie continues to be a leader. Every time it touches the 21, it bounces, and you can see closing at the top of its range on all those bounces. Great relative strength. This is accumulation. Berkshire Hathaway with a big shakeout over the last 2 days, but some serious strength today. Zim, the leading transportation ship stock, undercut off the 50-day back above the 21. CF, leading fertilizer, Big shakeout today. It started the day ugly, bounced off the 8, closed at the top of its range. Devon, still one of the premier energy. Every time it touches the 21, it bounces off of it. And that's it. That's your 21 over 21 leaders list. So as I said, 15 industry groups, 15 broad sectors, 21 industry groups. And that's going to wrap it. So again, what we want to look ahead for next week, what happens if we continue to go up and the 21 comes down when we meet it? Is it going to flatten out and turn up? That's a best case scenario. Maybe we go sideways for a couple days here as a consolidation after this big move up, similar to how we consolidated off the move up when we had that big shakeout on 124. So that's what we're looking for next week. On the downside, we don't want to give up the 8 EMA as it's going to turn from flat and turn up too, and any pullbacks to that should hold if this rally is going to stay into effect. And then, of course, the sweet spot for follow-through days is day 4 through 7. So that'll be Tuesday, Wednesday, Thursday, Friday of next week. We'll be looking for a true follow-through day. We've got a lot of decent bases shaping up in some former leaders that have come back and some that are bunch of them have given up, but some of them coming back strong. So that's going to wrap it. Always love your feedback. You can email me, don@revereasset.com, or phone 855-REAL-WELL. So wrapping up the week ending, February 25th, one trading day left in February. This is Don Vandenbord telling it like it is. Just the facts here, folks. No opinions. Thanks for listening, and have a great weekend.